We've had Jerome Powell being announced as the next head of the U.S. Federal Reserve. The change is coming at a time when the U.S. Central Bank has started unwinding its crisis-era monetary policies. Incidentally, other central banks, the ECB and the Bank of England, have also started a gradual and slow tightening process from here on. What does all of this central bank action mean for the markets? Mark McFarland, chief economist at UBP, is joining us on the show this afternoon. Thanks so much, Mark. Appreciate you taking the time to speak with us. Let me just first get your impressions on Powell's appointment. I think over the last few days, the markets had more or less come to expect that because of various news leaks. So not much of a reaction, really.
That's right. No, I think if you look at currency markets, particularly this morning, you can see that the dollar has strengthened a little bit, suggesting that the concerns about Powell being a dove have been overplayed somewhat. I think Powell essentially is the continuation candidate. It gets away from austere academics, avoids the hawkishness of Taylor, and you get a fairly steady pair of hands from here.
I'm just wondering whether Jerome Powell is also seen as, a bit, probably not the, the most obvious choice to lead the Fed. As in, he's not an economist. That's been pointed out. Some have also pointed out that he's taken a slightly light stance on financial sector regulation. I don't know whether the market is looking at any of those aspects at all.
I think you're actually correct in that assessment. I think Powell is very much the committee man. He's going to lead a monetary policy committee that will make decisions by consensus. I think under the Yellen administration, you had a much more centralized decision-making process from her on her own. I think also the point you mentioned about financial regulation is a correct one. I think if you tie in Powell with Treasury Secretary Mnuchin and also Trump's aspirations to reduce regulation, I think you can see why Powell has been appointed. It's very much a deregulation environment that Trump wants to follow.
But Mark, tell me, so that's on the deregulation side. In terms of monetary policy and the monetary policy agenda, I think it's probably fortunate that the appointment has come at a time when there's very little ambiguity on the direction that the Fed is taking. We know their stance on rates, but more importantly, we know their stance on unwind. There are numbers out there. So I guess in that sense, probably less disruptive, even though some would have argued that you could have easily continued with Janet Yellen in the chair.
You could easily have kept Janet Yellen in the chair because she was the one who designed the policy in the first place. They made it explicitly clear on how they were going to start winding down the balance sheet. They gave a very well thought out and easily understood set of guidelines and timetables for wind down. And it was pretty clear that interest rates would take a secondary position in policy terms and that they would go up very slowly. So I don't think anything has really changed from that perspective. So I think Powell really is not going to change the view that markets have of monetary policy in the US going forward.
Mark, speaking of which, what do you make of sort of this coming together of three of the larger central banks, at least starting the unwind process? But they've all been very, very careful. They've done what they've had to do, but they've sort of, peppered it with dovish comments enough to not, again, disrupt the markets.
Well, I think there's two elements to answer your question. I think the first is concern about the level of inflation. And whether those large asset positions on the balance sheets of central banks could be inflationary at some point. And then the second point is that particularly the European Central Bank doesn't want to be discouraging growth by holding on to quantitative easing for too long. And so I think the American Central Bank moving over the course of the last couple of months has to some extent preempted the European Central Bank. And so that's why you've seen the timetable for bond sell-off in the ECB. I think from the perspective of the Bank of England, it's slightly different. I think there was an emergency rate cut in August of 2016 after the Brexit vote that was largely unnecessary. And I think what Carney and co have been doing in the last couple of weeks is readying the market for taking away that emergency rate cut, but not talking about raising interest rates quickly from here.
True, so their scenario is a bit different. What does this mean? So the ECB and the Fed, not the Bank of England so much. What do you think it means for the value of the dollar and the euro, and how that pair trades based on the sort of the trajectories laid out by those two central banks?
I think there's a clear trend towards a slightly stronger dollar. I think the market has probably underpriced the risk of the American central bank from raising interest rates more quickly. Currently, there are two priced in, one in December of this year and one at the end of next year. The likelihood is that you get three over the course of the next 18 months. I think from the European Central Bank's perspective, they are quite reluctant to tighten policy. And as a result, I think the flow moves in the direction of dollars rather than in the direction of euros.
All right, Mark, just one last question. Apart from the currency pair and, of course, the government bond deals, are there any other markets that you're watching closely to see whether some of this unwind starts to impact mortgage markets in the US, or anything else that you're watching as indicators of the process of unwind starting to impact the economy or the markets?
Well, I think speaking from Asia Pacific, it's important to recognize that one of the beneficiaries of quantitative easing over the last 7 years has been Asian Pacific markets, including India, where the lowering of interest rates in the US and also the making available of large quantities of new funding has really benefited the economies of Asia Pacific. So I think if you're looking at one set of markets to give you an indication that quantitative easing is having a negative impact, it's looking at the equity markets of the Asia Pacific region. Currently to date, you've seen a little bit of a wobble. I think over the last 2 or 3 weeks, you've seen markets rethinking the assumptions that were made at the beginning of the year. But generally speaking, the impact of quantitative easing so far has been quite minimal.
McFarland, thank you so much for joining us this morning. Appreciate you giving us your perspective on the changes
welcome.
at the US Federal Reserve and, of course, changes in monetary policy as well.